Welcome to another edition of Inside Rosenberg and Estes. I'm Dave Lorenzo. Today we're talking about a topic that is extremely popular and has evolved over time. That topic is opportunity zones, and our guest is our resident expert here at Rosenberg and Estes on this topic, Adam Sanders. Hello, Adam. Welcome to the show today.
Hey, how are you? Great to be here.
I am great. So this topic is one that I hear people talking about all the time, and I hear it in multiple contexts. I hear it spoken about for tax purposes. I hear it spoken about for revitalization of areas of cities all around the country. So I'd love to get some clarity from you just on an initial definition. What is an opportunity zone?
An opportunity zone is an area designated by a governor of a state, which is a highly distressed area in that state, in which they will deem an opportunity zone. And then within that zone, there are certain tax benefits that come from the Opportunity Zone program, which was part of the 2017 Jobs Act.
So it wasn't just created as a tax opportunity. What's the initial intent behind this?
Now, it gives tax benefits to create incentive for developers, business owners, entrepreneurs to bring their either development or business into these areas and communities that need to be revitalized in certain ways or are highly distressed and could use certain capital coming in, businesses, jobs, things like that. There's been several programs like this over the years, and this just happens to be one of the latest ones.
I hear a lot about capital gains and deferring taxes related to opportunity zones. Explain how that works.
Well, there's a taxable event. Each taxpayer, or as an individual or as a partnership, will have a taxable event. Best example is upon the sale of, say, stock. Okay. In the past, that could not be used into one of these kind of federal tax credit programs or tax benefit programs. In this particular case, a capital gain can then be invested by the taxpayer into one of these programs, into an opportunity zone fund, which will then go into an opportunity zone property or business. Upon that, there are certain benefits they get.
What are the benefits?
The first is really a deferral of the capital gain tax that they would otherwise pay. Mm-hmm. So instead of paying it on the tax return for that year, which will now be in place, the new Opportunity Zone 2.0 will have a rolling 5 years. So it will be paid in the tax gets deferred for 5 years. Under the initial program, it was about 7 years. Let's see, it started in 2008, and now it's due at the end of 26, so about 8 years.
Okay. And first of all, who comes to you looking for help with this sort of thing? Is it a developer? Is it an investor? Is it people on both sides?
I get both sides.
Yeah.
Initially, when it first started, I would get a lot of property owners, developers, and just small investors that were trying to figure out how they could utilize it. And they're very excited because they're like, well, if I can defer my capital gain tax, maybe I can put the capital gain money to work, so part of it to work elsewhere. And then they wanted to know about how to structure a fund and maybe kind of do the project on their own. And then there were larger developers that just have a pipeline that say, okay, how can I set this up? So then when I bring my investors in, I have another incentive to give them that they would have otherwise not had.
Yeah.
And that created a certain benefit. We ran into a problem when people started to market properties as great opportunity zone opportunity. And it was, but truth of the matter is everyone has to be project first, business first. So I would always tell investors or even developers, if the project or the business isn't something you would do otherwise, maybe hold off and wait for the next one.
So this is kind of like a bonus. It's an added incentive. It's not like the deal has to be good on its face, and then this is an added incentive.
Yes, it is. And some kind of platforms are set up to continually utilize this. However, it needs to be because, truth of the matter is, the great benefit is the exemption of increased value at the end, which the end is 10 years. So this is a 10-year hold, and people have to be comfortable with that.
What is an opportunity fund, and how does that fit into the mix?
Well, Opportunity Zone Fund is really the gatekeeper of the program. It's where the taxpayer, individual or partnership or corporation, will invest their funds, the capital gain that they have that they want to utilize within the program. An Opportunity Zone fund is not all that complicated to set up. It can be a newly formed LLC, a legacy LLC, a partnership, but it has to be a partnership, so it can't just be a single member that's then set up and designated under an 8996 tax form as an Opportunity Zone fund. And then there's certain requirements about once it gets funds, how quickly it has to invest and how much of those funds it has to invest.
Like almost all of the funds have to be invested in an opportunity zone because it's an opportunity zone fund, right?
Yes, the 90% of the funds have to be invested within 6 months.
Okay. And are there any qualifications for the investors who invest in that? Do they, like, there's like other investments, you have to have certain thresholds of income or net worth. Can anybody invest in an opportunity zone fund?
Anyone can. Anyone can put a capital gain. From what I've seen, though, a lot of people put kind of the securities investor questions because they want to know that they have a sophisticated investor coming in, but there isn't any such requirement under the regulations.
What kinds of property can go into opportunity zones or fit into the opportunity zone rules?
Well, initially when the program was announced, it was any property purchased after the bill passed in 2017. So you would say 2018, January 1st, 2018, any newly acquired property. There were ways to bring in prior owned property through ground leases and some kind of partnership technicalities. But basically, it was all new property being purchased back then. So now we're at the point where it's going to be new development, new projects, new renovations, substantial renovations of current properties.
Real estate and businesses, they both can go into opportunity zones. What's the difference in how you would treat a business going into an opportunity zone versus just an asset, a real estate asset going into an opportunity zone?
Well, a real estate asset is a little easier to visualize because it's a project. You'll go in, you need to double the basis to substantially improve it. So say if you buy it for $10 million, you put $10 million in, that would effectively be doubling and qualify for the substantial improvement kind of test. When it comes to a business, you're basically, it's a startup. You're thinking you're going into an area that's underappreciated, that probably doesn't have a lot of businesses. And so you go in, you lease space in a warehouse and you create a business. There, certain amount of the work in that business has to be performed there. A percentage of the employees have to be out of there. It becomes more tax regulated than just kind of building a real estate development, building it out under a construction budget and construction plan.
So it can be the headquarters as long as the headquarters is doing a certain percentage of the work. Is that?
Yes,
okay.
It's a good amount, a substantial. It really would have to be that way. I always thought of it as a great place for a startup because if you think if you're an investor that invests in 100 different startups and you get them all located in an area, and there are some areas not far from Silicon Valley that were in opportunity zones, and you station a bunch of them and 2 or 3 hit, the value will greatly increase your capital gain. And at that point, after 10 years, you can then sell the stock and not pay capital gain on that increased value. Is pretty amazing.
And that's the language that's in the in the law. That's the active conduct. I'm reading it here to make sure I understand it. The active conduct of a trade or a business, right?
Yes.
That's what that means. What you're talking about, like the substantial amount of work that's being done in the opportunity zone. And startups make sense because when you're a startup, you don't have branches all over the place. You're just in that one location. So how should investors and developers think about identifying the right opportunity zone?
Well, one is you need to be investing in a project you feel comfortable with. So if someone's real estate minded, it would be a real estate project, either attempted original use or a non-original use, substantially improved project. And in that regard, it's got to be project first. You got to believe in the project, saying I'd invest in this even without it. I just happen to have a capital gain that I can utilize. This is great. When it comes to a business, same thing. You need to be comfortable with that business and the growth on that business. And that there are certain businesses that aren't included, very finance-based, professional-based, some farming. There are a handful of some vice properties. Those aren't included. Because again, it comes down to it needs to be a benefit for the community. So you need a business that is going to help the community, employ people in the community, help increase the surrounding area, and just by bringing in maybe ancillary businesses that need to help that help support the businesses that are coming in.
So for real estate developers, because this is a real estate firm, for real estate developers, why can opportunity zones be particularly useful for them?
Well, there are different types of real estate developers. There are larger ones and smaller ones. If we start with the larger ones that have pipelines, they know where their projects are going to be. A lot of them go into these areas already. A lot of them are already doing their due diligence. They already know the projects. They know the timing. And they buy and sell properties themselves and now can roll in capital gains. And it helps, it creates a little more buffer and margin within their property, whether it's to cut costs or to just increase profit for their own investors. When you get to smaller developers, it can be a benefit as slight marketing that kind of pushes someone over the edge that's debating whether to invest, because smaller developers tend to need more outside capital.
I've heard you mention substantial improvement as it relates to these types of projects. What is substantial improvement? How do we figure out if we're substantially improving a property or business?
Well, the best way to think of it is if you buy an underutilized building that isn't really that's poised for a renovation, that can be turned into something that the community can benefit from, that can employ more jobs, bring in more business, and not just the business in there, but ancillary businesses in around to support it. So if you have that and someone buys it and then invests $1 over the amount of the purchase price, you would double the basis, and then it would qualify. And that needs to be done within 30 months. And then just the money that would be put in under a working capital safe harbor plan would just have to be deployed within 31 to 62 months.
All right. What is the working capital safe harbor, and why is it so important in these projects?
So sticking with real estate, when someone purchases a property, they're able to use capital gains funds through an opportunity zone fund that will qualify. They also can use funds to rent it to part of their project, to build and substantially improve the project. And there, all the money is not thrown in at once. It's kind of paid out over time. So to do that, they've provided a working capital safe harbor plan, which requires 3 prongs. 1, that you detail the plan. 2, that you have a timeline of the plan. And 3, that you then have followed and executed that plan. That's something that's very important to be to be documented and put in a file, just in case the IRS comes knocking and wants to review it. It gives more flexibility. I always tell clients to put that money in up front so it just gets into the project earlier. But it's, people that develop are used to construction budgets, construction timelines. And then we then insert it into kind of a form memo that will then execute it.
The substantial improvement test originally created some practical problems because it was measured asset by asset.
Yes.
How have they improved it and made it easier now for people who are working in opportunity zones to have their projects pass the substantial improvement test?
Well, the issue at first you had larger projects that had multiple phases and multiple buildings that were on maybe the same exact tax lot, and they were looking at it based on asset by asset, building by building, which then would cause problems, accounting problems, and just timing problems as you were rolling each phase out. And then, because the last thing someone wants is to invest in one phase and then be, held up for their 10 years based on the last investment coming in at the end. Mm-hmm. So here, you're not allowed to aggregate the project and spread it out over time, which is better for the investors and better for the developers.
How do opportunity zones differ in your work across the country? How is it different, say, working on an opportunity zone in New York compared to other states where you've worked on projects?
Well, in New York, a lot of the opportunity zones that I saw had already started to be redeveloped. Just because, again, there are other programs, and a lot of the areas around New York have infrastructure that's just underutilized. So developers look and say, okay, I can build a project along a train thoroughfare, Metro North. I can build a project in downtown Flushing. These were areas that were poised, and by the time opportunities came out, they had already seen a bunch. When you get into more rural areas, there's less infrastructure. It takes a little bit more to get developers to go in there because the population is a little smaller. So what the federal government has done under the beautiful bill, which introduced Opportunity Zones 2.0, is they've added additional incentive for people to do opportunity zone projects in rural areas where the deferral is 10% under the normal opportunity zone investment. Here, the deferral of capital gains is 30%. The step up is 30%, which is a huge benefit. And it's, I think it's working.
Let's talk about when people come to you. Let's start with a real estate developer. Does a developer come to you and say, Adam, I got this area. I'm looking at it for an opportunity zone. What do you think? And then what do you do? How do you help them if they come to you with that?
I immediately go to a map to see that it's in the opportunity zones. Mm-hmm. Now, again, right now, it's based on the prior census. We're now about to introduce new opportunity zones this month, maybe in August. It's just started July 1st. So you always got to make sure that the project is in an opportunity zone. There's been several times people have called me very excited, and I've had to politely tell them that it's not. And the conversations have not continued. Then I jump to the idea that where's the project? Have you started the project? How far along is it? Is it investment money you need? What is their ultimate goal? And why are they coming to me about structuring an opportunity zone project? And if it's, we need investors, or it's a benefit to the investors, I have them lined up, we can keep going forward. If there are issues about, I want to market it as one, we'll go, okay, then we kind of pivot a little bit and say, okay, well, then let's talk about where the project is. Because again, it has to be project first, because ultimately this is a 10-year hold for whoever's investing. So they also want, and with that, I want to know, what is the ultimate goal of the developer? Do they want to sell it in 3 years, 5 years? Well, that's going to be a problem, because the investors will want to see the operating agreement for the project, for what is the opportunity zone business, which will then develop the project. So they want to have some control. They don't want it to be sold, have a taxable event, because then they may have to reinvest their capital gain into another opportunity zone project.
Yeah. So now an investor comes to you. What are the first few things you do when the investor comes to you? And let's start with the investor comes to you and they are looking for an opportunity zone project. They're not an investor who's coming and saying, I got to avoid unrealized, I have capital gains that I'm realizing, I got to avoid paying taxes on them. Then that's somebody where you would say, let me introduce you to an opportunity zone. Let's say this is a person who says, I know what I'm doing, I have these funds, I want to invest them in an opportunity zone. What's the first thing you do for that person?
Well, I need to understand what their appetite, the amount of money, and what their appetite or risk is for. Because there are some institutional platforms that you can send them that will structure that are prepared for these type of investors. And then there are some developers that are around just always looking for additional capital that might be in an opportunity zone that I have, through a networking group, access to, or at least pools of people that then have access and understand who would be looking for this. But it really, you want to know the investor, you want to know their appetite for the type of project. Do they understand the type of project, and how comfortable are they in opportunity zone businesses that are properties or businesses?
Okay, so let's go the opposite end now. Let's start with developers. What type of developer is this absolutely not a good fit for? Who should avoid opportunity zones, or who shouldn't do them?
A developer that does not have any control of their timeline, I think, is problematic. I think everyone should be, if someone's going to develop and they're experienced, so let's exclude inexperienced people in their first time out. If someone's experienced and they know how to build and they know what project, they can utilize the program. The problem you get into is if someone is not control their timeline and they take money too early. I've had a couple of very sophisticated developers that are talking to very sophisticated investors where the timing just didn't work. And we talked about it, we figured it out, but they were waiting. There are certain approvals in some states that will take 2 years. Okay. And if you were to do that, you would then have 6 months left to rush out the funds. And usually it gets extended. So there are times to be kind of cautious. With smaller developers, sometimes that's even harder to get through.
Yeah.
So it's usually more of a timing thing than a developer thing than anything else.
Now let's go to the investors. On the investor side, who as an investor would you counsel to not invest in an opportunity zone?
I would not. An investor that I'm not confident is prepared to then pay their tax when they need to. When the program first started, there were a few of us that kept joking that a great business would be to start lending money to investors at the end of 2026 because none of them had saved up the money to ultimately pay the capital gains tax that they need to. Yes, they got either a 15 to 10% step up in basis related to it, which is effectively a discount on what they're paying, but still, they still need to pay it. So that's kind of one of the things I always concern about investors because they think about it as, oh, this is great. I don't have to pay tax. Well, you do. It's just deferred. And what are you going to do with that amount that you're deferring, and where are you going to put that money to good use? Now, as a real estate attorney, I point it out, but it's not my expertise. So I will always make sure someone has a team behind them. Who's your accountant? Is your accountant familiar with the program? Is your accountant understand the time frame that comes into place here, and that ultimately you'll need to file with your next tax return, pointing out that you are an opportunity zone fund and you're deferring capital gains tax. So those things are important, and sometimes even with a tax attorney coming in that really understands the code and the regulations within the code, because some other code provisions come into play with partnerships as well.
So let's talk about the team, right?
Okay.
So you're a corporate transactional attorney. You're also involved in real estate transactions all the time. So you understand both aspects of that. But
Yes.
you need someone on your team who's familiar with real estate law in the jurisdiction where the opportunity zone is. You also need someone who's familiar with corporate documents and doing transactions, correct?
Correct.
Who else is part of this team?
Well, so those areas are something that, luckily we're able to handle ourselves. Someone should always have an accountant on their team that is familiar with the Opportunity Zone program and really the timing of it and the way to track the funds from the Opportunity Zone property, Opportunity Zone business, and Opportunity Zone fund, because they want to make sure that compliance is occurring. At the same time, they may want a tax attorney that they're comfortable with, that they can talk to, that really understands the code and the regulations within the code and the various provisions. Because there are times where when we've structured certain deals and we've had to alter them because there's a provision in the code that's not opportunity zone related, it's partnership related. So a couple of times, like they're vital, and they're vital when we structure the deals.
All right, who else needs to be involved? So you have your accountant, you have your corporate transactional attorney, you have your real estate attorney, tax attorney. You need to check with a tax attorney at all, or
it depends. But
Yeah.
I would say that as long as you're getting proper tax advice, whether it's through your accountant or your tax attorney, I think that will work. Sometimes, though, there are questions that only a tax attorney really can answer, and it's usually related to more complex structuring.
Okay. And overall, anybody else that needs to be involved in the process? Anything that you can think of where any other professionals that need to be involved?
Well, I would say the people that need to be involved are, if you're a developer going into an area, you need to reach out to the community. The community needs to be involved, whether it's But that comes into place with any development, especially in a low-income community, because you're coming in to benefit. They want to benefit the community, technically. That's what they want to know. They don't want you coming in, causing a mess, building the project that then doesn't benefit the community, that then just benefits people coming into the community and taking from the community. As long as you coordinate with community leaders or various other contributors to that community, I think that's a huge benefit.
Let's talk about your experience in this area, because I know you've worked on projects inside New York City, New York State, and outside of New York State. When people come to you who are outside of New York State, how do those folks generally find you? How do they stumble on Adam Sanders at Rosenberg and Estes here in New York?
Well, sometimes very kind of strange ways that I'm not prepared for. But when Opportunity Zones first launched, there was a lot of marketing. We did a lot of conferences, a lot of panels, wrote a bunch of articles, and then randomly, I had 4 doctors out of Tennessee reach out to me that wanted to buy their own building and create their own office space in there. In doing so, and invest capital gains that they had, and they were buying and selling properties to kind of, each time incrementally increase the amount of capital. So that's where they had focused, and they reached out to me to structure the whole program for them.
That's an interesting case study. So there are 4 doctors in, let's say, complementary practices or the same practice, whatever, and they want to set up their own building. Were they required to move to a different part of the city because the Opportunity Zone was in one part of Tennessee or the city in Tennessee, and then they had to move to a different part because that's where the Opportunity Zone was?
Yes.
Okay.
They need to. It needs to operate. The renovation they were doing was going to be a multi-tenant place, and they were just hoping to have their own office in that space. But then they need to then go to that space, then it wouldn't qualify.
Yeah.
I've had other clients in upstate New York that were just down the road from an Opportunity Zone, and we discussed long and hard if he wanted to move his business into it. And then technically it wasn't a startup. So we had to bring in a tax attorney who really understood the code to see if it would work. And ultimately they decided against it because of the cost to move just didn't pencil out.
Yeah. Yeah. But it was in the doctor's case, probably the attraction was, well, our practices are complementary, we'll be in the same building. That's a good opportunity for them to begin with, and the Opportunity Zone to defer capital gains tax until a later date was just a bonus. And that fits in with your premise of it has to be a good development, it has to be a good project first and foremost, and then use the Opportunity Zone, the tax savings from the Opportunity Zone as a bonus.
Yeah, in that regard, these were 4 doctors that were already investing together, that worked together, closely together, that knew each other for a long time. So it kind of organically came together.
We had one in South Florida where the person who took advantage was a real estate attorney, recognized that these buildings that they were going to develop were going to be in an Opportunity Zone, not an attractive area, right next to the Bright Line Railroad. What he did was he created a multi-practice specialty from attorney practice groups that would refer to each other. So the attraction of the project was, we have these different practices where you guys are all referring to each other. Now we're going to bring them together all in this one building, small practices, not big firms. And he said, and it just so happens to be that we're going to put it in this area that's right off the highway. And it turned out to be in an Opportunity Zone, and it was a fantastic development opportunity because everybody wanted to be there for a specific purpose. Nobody cared that it was an Opportunity Zone until there was the tax savings associated with it, right? The capital gains tax savings associated with it.
In that situation, the idea of creating almost a shared office space type situation where you're going to substantially improve whatever building's there, you're going to build it and help the area and bring in businesses that are then going to work from there. That's a great Opportunity Zone business, Opportunity Zone property development play.
And it turned out that property was just by good fortune steps away from a train station that was right on the Bright Line.
Perfect.
When they first moved there, nobody wanted it because it was right on the tracks, and then it became steps away from the Bright Line. So it worked out to be a good project. Adam, what's the difference between Opportunity Zone 1.0 and 2.0? So the Big Beautiful Bill was passed a year ago. What's the difference between the first iteration and this one?
Well, the first is that it becomes permanent, okay, which was always an issue because taxpayers were always kind of concerned investing towards the end because they didn't know if it would continue. And if you think about it, if you have a project, so 1.0 expires effectively at the end of 2026 because at that point, the deferral capital gains tax is due. So you couldn't defer anymore and you couldn't invest. So there's always concern about, okay, what happens after that? And my project needs more money. Do I not invest in that? Or my business needs more money. Do I not invest in that? So that was always a concern. So making it permanent was important. So that's what the bill did. But then it brings up the question, okay, well, now what happens with those projects when I do need to put it in? Because the the new Opportunity Zone starts January 1st, 2027. And then the wrap-up has to occur by the end of 2028 related to the prior Opportunity Zones. So the question is, well, what happens now? So what Treasury recently came out with guidance that says, okay, we understand the issue. Basically, projects that have a working capital safe harbor plan in effect can continue operating under that plan, provided that the time frame still works, the budget's still in play, and that you're still executing underneath that plan. Additionally, when it comes to businesses, you're allowed to continue to fund with Opportunity Zone under the initial Opportunity Zone 1.0 capital for ordinary course of business and or capital improvements related to the initial startup under a certain plan. And that works, and that will help kind of relieve certain stress. And then, starting at the beginning of 2027, you will then be able to start to invest in new Opportunity Zones with a 5-year deferral of your capital gains, which will be rolling each year based on when you invest, and then still the 10-year hold.
Of course, New York State has to throw their 2 cents in. So let's talk about the decoupling of New York State from the federal Opportunity Zone tax treatment. What does that mean for people here in New York?
Well, what it means in New York is that when your state income tax calculation comes in, you cannot take out the capital gains for a specific year that you may be deferring under federal taxes. So, for an example, if you have, if you invest $100,000 of capital gain and you're deferring it under federal, you don't include that in your capital gain your taxable income calculation or capital gain tax amount at that time. But you have to include it in your New York State and how that's calculated. New York is not the only state to do this. To me, it tends to be a more political issue related to how the program was put in place. There are other states, so if someone's in a certain state, they should really check to see if they're affected by decoupling.
So there's a million moving parts when it comes to Opportunity Zones. The first step should be to reach out and contact someone who's an expert in this area. I mean, I would prefer that people reach out and contact you. What is the checklist that a developer should follow when they're starting up one of these projects? And then we can look at investors, and let's make the final point of that checklist. Call Adam Sanders. What's the checklist that each of those folks should follow?
Well, I mean, there's no concrete checklist. I would just give a couple pieces of advice. One, any developer that calls and that's interested is to double check to see if the property is in fact in an Opportunity Zone, and then put down on paper your thoughts, because a lot of these conversations tend to pivot, and people tend to pivot and keep pivoting until I tell them, okay, you're perfect, you're ready to go. So the idea of having something written down usually kind of gets them to that point prior to the call. It just can be more efficient and more effective. When investors call, I just really need to know, okay, I can talk to them. Maybe they have an idea of what type of project they want, what they're used to. And they kind of need to they need to be comfortable with the investment because it's a 10-year hold ultimately. So it's really, that can be just a conversation. Investors can call and it can simply be a conversation and I can steer them into the right direction.
What's the best way for people to get a hold of you to make that call?
They can either call me in the office at 212-551-1275 or email me, which is probably the best because then they can give me a little more information I can digest before we then connect. And that's at asanders, ASANDERS at rosenbergestes.com.
This has been a great conversation with Adam Sanders. He's the resident expert here at Rosenberg and Estes on opportunity zones. His contact information is up on the screen right now. Please reach out if you have any questions about developing in an opportunity zone or if you're considering investing in an opportunity zone. Adam is the person to see. Adam, thank you so much for joining us here today. It was an absolute pleasure.
Great. Thanks for having me.